Now let's get on with today's webcast and the recovery of equities. The US and UK equity markets fell in tandem. Both the FTSE 100 and the S&P 500 fell around 35% over a month between February and March. In the UK, the FTSE 100 has since grown 20% from its low point and is now 20% off of February's highs. The UK market has lagged behind the US market in its recovery, as Ben Arnold of Schroders outlined and predicted in Arlingclose's first ever webcast, mainly due to the larger tech sector in the US. We will draw on this further later on. Over in the US, the Nasdaq is at new highs, up 22% year to date, and the S&P 500, a weighted index of the 500 largest US publicly traded companies, has this week reached new highs also, after being catapulted up 51% since the lows of March 23rd. With US GDP contracting by an annualized 33% in Q2, we ask the question, who needs economic growth when all you need is QE, and in the case of Tesla, stock splits? Talking about QE, let us zone in on the US. The Federal Reserve's balance sheet exploded in March as Chair Jerome Powell responded to the COVID-19 pandemic and the complete lack of liquidity in the markets as a whole. In mid-March, the Fed announced approximately $700 billion in new QE. The graph shown shows how this has resulted in an additional $3 trillion in assets on the books of the Federal Reserve. This increase is unprecedented, a word which has been bandied about a lot over the last few months and completely dwarfs what was seen during the global financial crisis, which can be seen labeled on the left of the graph. Once the lender of last resort, now appears to be a lender to the entire resort. But the rapid expansion of the Fed's balance sheet has stopped in recent weeks. It will be interesting to see if an easing of the Fed's expansion will have a negative impact on equities over the coming weeks and months. In my opinion, it is now clear that the US is experiencing a significant asset bubble as the stock market continues to be completely disjointed from the real world economy. Markets are bullish on good news and semi-bullish on negative news. The Wiltshire 5000 index is widely accepted as the benchmark for the US equity market and indexes the market value of all actively traded US stocks. The ratios plotted on the graph are used by many to signify whether the market is overvalued and is a ratio touted by perhaps one of the most famous investors of his generation, Warren Buffett. The market cap of this index to US GDP ratio has this week surpassed 1.8 times. This can be seen on the far right of the graph. This level has never been reached before. Again, I could use the word unprecedented. This eclipses the dot-com bubble of 2000, which saw excessive speculation in internet-related companies, and a peak in this index of only 1.4 times in comparison. Of course, this has been a two-way effect. US GDP decreased by an annualized 33% in Q2, while equity markets have recovered from the March crash to reach record highs. TrimTab's investment research state that August is set to be the third month of the past four where insider selling has exceeded $15 billion. What is the relevance of this? The relevance is that insider selling is at a pace not seen since 2006. This could be a warning sign for the booming market, as insiders, by definition, are privy to more information about the true health of their companies than average investors. I believe this chart shows clearly how the recovery of the S&P 500, a weighted index of the 500 largest US public traded companies, has been reliant on the performance of 5 stocks in its recovery since the huge 34% drop seen in late February, early March. These stocks are the big 5 tech stocks: Facebook, Amazon, Apple, Microsoft, and Google, who are up 40% since the start of the year and account for 22% of the entire market cap of the S&P 500. Yesterday, Apple became the most valuable company in the world, briefly passing $2 trillion market cap. This is larger than the GDP of Italy by some distance. In the last 30 trading days, Apple alone has gained $400 billion in value. That's enough to give every American an iPhone 11 Pro Max and still have a lot of money left over. The rest of the 495 companies of the S&P 500, or 99% of the S&P 500 if you prefer, were down 5% year to date, as can be seen by the light grey line on the graph. If Facebook, Amazon, Apple, Microsoft, and Google, the big five, catch cold and fail to generate enough earnings to justify their valuations, the very dynamic that led to those stellar gains could also result in painful losses. The same goes for pharmaceutical and healthcare stocks that have also performed well. A Democratic victory in the US will limit the power of drug manufacturers, and perhaps monetary penalties will be introduced to punish high prices of their products. There is another company not currently included on the S&P 500, which has seen immense growth over this period, outperforming the market more than any other stock and up over 700% over the last year. And that company is Tesla. Tesla specializes in producing electric vehicles, or cars of the future, but is perhaps more notorious for its maverick CEO, Elon Musk. If he isn't found sending rockets into space with SpaceX or smoking cannabis on the Joe Rogan podcast, he can be found getting in trouble with the SEC, either for stating that he will take Tesla private at $420 or for tweeting that Tesla is overvalued at $700. Tesla's share price is now an eye-watering $1,800, with a market cap worth 2 times all major automakers and airlines in the US. This stock has the largest market cap of all automakers in the world by some margin, despite only having a tiny fraction of the sales. I know that the equity markets are meant to be forward-looking, but surely if there ever was a sign of a bubble or that value investing is currently dying on its sword, then this stock, with its cars of the future, clean energy, and PE ratio over 800 times would be it. Tesla will be soon performing a 5-to-1 stock split to bring the stock price into a more marketable range, and is now also eligible for entry into the S&P 500 after 4 consecutive profitable quarters. So who knows what the future holds? Many tricky investors have fallen foul of short positions being liquidated, and who is to say that this won't continue? My personal opinion is that a large correction in the Tesla share price is long overdue. The VIX index. Most of you will be familiar with this graph from your strategy meetings. The VIX is a benchmark index designed specifically to track S&P 500 volatility. Most investors familiar with the VIX commonly refer to it as the fear gauge because it has become a proxy for market volatility. Volatility is often, but not always, associated with negative stock market performance. The VIX peaked at over 80 in mid-March, as you can see on the graph, slightly higher than the previous high experienced in 2008 during the global financial crisis. However, since this, the VIX has been coming down to more stable levels and is now around 21, 22. Now, I may confuse some of you. The VVIX, or as I like to refer to it as the VIX squared, has also been falling. This measures the volatility of the S&P 500 and often referred to as the panic gauge. Both of these measurements falling, that being the VIX and the VVIX, represent easing volatility in the equity markets and a stabilization of volatility, which has been eased in the most part as a result of the enormous levels of QE engaged in by the Federal Reserve, as they artificially set about increasing asset prices. This Monday saw the lowest volume full trading day since May 2006. Markets certainly appear to be cooling off. Incredibly, of the last 17 full trading days, the S&P 500 has closed up on all but one day. The main benefactors of QE have been the CEOs of the large tech firms, which we touched upon earlier. Jeff Bezos, CEO of Amazon, has seen his net worth increase from $113 billion to $189 billion. Bill Gates, 98 to 114 billion, and Elon Musk, 25 billion to 68 billion, to name just a few. Unquantifiable levels of wealth. The devaluing of the US dollar, as perceived by many in the face of enormous levels of QE, has led many investors to move to what are seen as safe haven assets. Gold and silver have seen huge gains this year, with gold reaching highs above $2,000. However, it's important to note that this is not a high in real terms. Also, cryptocurrencies, like the well-known Bitcoin, which has a fixed supply, unlike fiat currency, like the dollar and the pound, has also seen huge gains of over 100% after falling sharply in March. To conclude, the policy response to COVID-19 from central banks and governments has been swift and sizable and helped lift markets, as policymakers have aimed to build a bridge to the other side of the virus. However, a full economic recovery can only take place if rising activity doesn't also lead to rising infections. The future remains uncertain, and it's important to invest in equity funds with a long-term horizon. Most of you listening will be income investors and therefore primarily interested in income yield. As we have already flagged in our investment update that we circulated to clients in April, local authorities should be prepared for lower income from bond, equity, multi-asset and property funds. Equity funds are likely to have the largest downward adjustment, and income may be up to 50% lower than income received in previous years. Big banking groups will not be paying out dividends. They will instead be focusing on maintaining robust capital and liquidity positions and entering this slowdown with more than sufficient capital to accommodate the combined simultaneous impact of severe UK and global recessions. Oil companies have also been hit hard as a result of mainly the oil price itself. Royal Dutch Shell announced a second quarter dividend of 16 cents per share, in line with the 65% reduction seen in the first quarter. Shell are not alone. BP has halved its shareholder dividend and posted a $6.7 billion quarterly loss after the coronavirus pandemic hit global demand for oil hard. I feel like I've been droning on for a while now, so I will hand over to Phiroza, who heads the Arlingclose funds team, to shed some light on equity funds performance and what to expect going forward. Phiroza, are you there?
Yes, thank you. Thank you, Perry. Yes, you've just described the rather stellar performance of the US equity markets, particularly when you see headlines like Wall Street wipes out all pandemic losses as the S&P 500 hits new record highs, which happened on Tuesday of this week. And then you take a look at, you just mentioned Apple, where its capitalization is now over 2 trillion. And think about this. It took around about 42 years for the market cap of Apple to hit 1 trillion. And it's only taken another 2 years to hit 2 trillion. So you've seen this huge bubble going on in tech stocks. But when you come back to the UK and see what the FTSE All Share and the FTSE 100 have done, unfortunately, it's nothing quite as impressive. The falls were quite swinging and large, even in the FTSE All Share. If you just take how much it fell from December 19 to March 2020, that was about 56%. It has risen since by just shy of around 10%. Similarly, for the FTSE 100, the falls were also large, but the improvement since then is just around the 10 or 11% mark. So you might say, so what is lagging out here? And again, it's the large tech stocks are not in these particular indices. And how did the funds in which our clients are invested do? Well, you could see that their share prices followed down where the markets were going, and there were quite substantial unrealized capital losses there. We've seen a better improvement since then. So when I'm talking about the unrealized losses for the UK equity income funds, they kind of ranged between around 15% to nearly about a third. But these are, remember, unrealized capital losses. And for the global equity income funds, again, some were as low as around just about 5% and then went up to around 20%. But the improvement again has been varied across the board. The UK equity income funds, just that little bit better, but still less than 10%. The global equity income funds, one has almost sort of traced back where the MSCI World Index has traced back, i.e. up by around, nearly 17%, which is pretty good going if you ask. But again, these are unrealized capital gains since the end of March. Perry mentioned that the wave of UK dividends that were cancelled or cut, but you also have to remember some were deferred. But let's just put it, I took a look at the numbers the other day. The dividend cuts in the FTSE 100 itself amount to around 25 billion between March through to July, and just around 12.5 billion has been maintained. But there are quite a few deferrals here. In fact, one of those deferrals, BAE, has recently paid a dividend, and you could see more of this coming through. So deferral just means that the payout is not right now. It could be pushed into the latter half of this year or perhaps into 2021. And again, Perry mentioned the UK banks. they made coordinated announcements that they would hold payouts for 2019 and 2020, and this includes all the large banking groups, Barclays, Lloyds, HSBC, and HSBC is one of the largest of that group in terms of the pounds that it pays out in terms of dividends. We've heard about Royal Dutch Shell and BP halving its dividends. But it's not all doom and gloom. There are other big players in the dividend world. These are the pharmaceutical companies, GlaxoSmithKline, AstraZeneca, etc. They should be continuing with the payment of their dividends. And we're just going through that interim season right now where this is the earnings season. So some companies might just choose to hold back. And the one thing to remember is that longer term investors would prefer to see companies get through this difficult period with as much resilience as possible. So controversially, it might sound that it sounds silly, you know, turkeys don't work for Christmas, as they say, so why should income investors actually support a dividend cut or a curtailment? Well, if that company can protect its financial strength in the face of what is a very difficult to assess economic downturn and perhaps the timing of any full recovery, instead of just blindly pursuing maintaining dividends and dividend targets that were set in a completely different environment, it makes economic sense to actually defer them or to delay them, because an unsustainable dividend ultimately ends up destroying shareholder value. So it's important not to lose sight of that amidst this market upheaval. And of course, as far as the outlook goes, we don't quite know where we are going right now. And quite frankly, even the equity markets need to assess this. So again, you will likely see the volatility in these stocks and in your funds as far as the capital values go. Dividends will be paid, but perhaps a little bit lower than what you may have received in calendar 2019. But just to bear in mind, if there's a second wave of the pandemic, or even a series of local lockdowns that are extensive and it hits industrial and manufacturing and services, that could again knock business and investor sentiment. The FTSE 100 has made progress from its depths in March. Right now, it seems to be anchored around 6,100, where it was this morning, and it's been trading around that level since May. We also have the US presidential election on the 3rd of November, and you cannot take away the market volatility that will surround the period leading up to it, and perhaps an outcome, particularly if it's a very, very close call. And finally, it's down to Brexit and the terms that the UK agrees with its major trading partner, that is the EU. These are the things perhaps just a few months into the distance, but let's not lose sight of that. So if there are any questions, I'm more than happy to answer that, but hopefully that's given you just a little bit about where the equity markets have been. If you want to discuss any of the funds, particularly in your portfolio, please feel free to contact us for that.
Thank you, Phiroza.
Questions? Yeah.
And thank you everyone for tuning in. I found that very insightful. Thank you, Phiroza, again. Next week, David Blake and Amar Jandu will be discussing borrowing on the last segment of Summer Shorts. We will then return in September with guest speakers, so please keep your ears and eyes peeled for announcements on that. As always, please follow Arlingclose on Twitter and LinkedIn channels if you haven't already, to be kept up to date with insights, webcasts, and economic news. Thanks again, and goodbye.